Nvidia, the darling of the chip world, sent shockwaves through the market. A 10-for-1 stock split. Suddenly, shares previously out of reach for some investors seemed attainable. The psychological impact was undeniable. Headlines screamed about the split. Message boards buzzed with excitement. But here's the thing. Splitting a stock doesn't change its intrinsic value. It's like slicing a pizza into more pieces. You're not getting more pizza, it's just divided differently. Despite this simple truth, investors often react strongly to splits. It's a classic case of behavioral finance at play. We're hardwired to see a lower sticker price and think bargain. Nvidia knows this. The timing of their announcement, amidst a surge in demand for their chips, was no accident. It was a savvy move to capitalize on existing momentum. Stock splits tap into a powerful psychological bias framing. The way information is presented influences our decisions. A $2,000 stock can feel intimidating, even insurmountable. But a $200 stock, suddenly, it feels within reach, even if it represents the exact same ownership. This feeling of accessibility can trigger a rush of excitement, a fear of missing out, FOMO. Investors, especially retail traders, pile in, hoping to ride the wave. This isn't a new phenomenon. We've seen it time and again. Remember Apple's stock split in 2020? The share price quadrupled in the following year. Tesla, too, experienced a similar surge after its 2020 split. These events reinforce the perception that splits are good news. Investors associate them with growth, with success, but correlation doesn't equal causation. Traditional finance struggles to explain these reactions. It assumes investors are rational actors driven solely by cold, hard data. Behavioral finance, however, offers a different perspective. It acknowledges our emotions, our biases, our tendency to make irrational decisions, especially in the face of uncertainty. Stock splits play on these very biases. They create the illusion of value, the illusion of momentum. Understanding these psychological factors is crucial for navigating the market. It's not enough to just look at the numbers. We need to understand the narratives that drive investor behavior. We need to recognize our own biases and how they might be influencing our decisions. The market is not a game of perfect information. It's a messy human affair driven by both logic and emotion. The frenzy around stock splits, particularly in the tech sector, should give us pause. It echoes the heady days of the dot-com bubble. Back then, companies with little revenue, sometimes just an idea, soared to astronomical valuations. Stock splits were commonplace, fueling the speculative mania. We all know how that ended. The bubble burst, wiping out trillions of dollars in wealth. Now, this isn't to say that Nvidia is in the same boat as those defunct dot-coms. They're a profitable company with a dominant market position, but the parallels are worth noting. The market's exuberance, the focus on hype over fundamentals, the tendency to chase momentum, these are all warning signs. We need to be cautious, to separate the signal from the noise. Nvidia's decision to split its stock wasn't just about investor psychology, it was also a strategic move. By lowering the share price, they made their stock more accessible to a wider range of investors. This increased liquidity can be beneficial, making it easier to buy and sell shares. It can also lead to a broader shareholder base, potentially attracting more institutional investors. Furthermore, a lower share price can make employee stock options more appealing. This can be a valuable tool for attracting and retaining talent, especially in the competitive tech industry. So, while the split itself doesn't change Nvidia's underlying business, it can have indirect benefits. These benefits, however, are often overblown in the short term, driven by market sentiment rather than tangible results. The bottom line is this: a stock split doesn't change a company's fundamentals. It doesn't magically make the company more profitable, nor does it guarantee future growth. Nvidia's success, post-split, will depend on their ability to continue innovating, to meet the growing demand for their products, and to navigate the ever-changing technological landscape. Investors would be wise to remember this. Don't get caught up in the hype. Don't let emotions dictate your investment decisions. Do your own research. Understand the company, its industry, its competitive landscape. Focus on the long-term fundamentals, not the short-term fluctuations. The market may be driven by psychology in the short run, but in the long run, it's the fundamentals that matter.